Hello, here's an example of the accounting cycle as far as making journal entries or converting transactions into journal entries of a debit and a credit, then posting those journal entries to T accounts or the ledger, and then from those T accounts preparing the statement of income, the statement of shareholders' equity, the balance sheet, and the statement of cash flows. So in number 1, when we collect $12,000 in cash from shareholders and issuing common stock, we're going to be debiting cash for $12,000 and we're going to credit common stock for $12,000. Since the cash is flowing in due to contributed capital, that is, when we look at the cash flow statement, it could be either operating, investing, or financing. And since it's shareholders' equity, it's a financing inflow. Borrowed $5,000 from a bank due in 3 years, that's a long-term liability. So when we borrow money, we debit cash because we receive cash of $5,000, and we're going to credit note payable or long-term note payable for $5,000. Since it's a long-term liability, it also would be a financing activity as far as cash flow is concerned. Number 3, purchase 2 parcels of land for a total of $10,000 cash. So we're going to debit land for $10,000 in total for those 2 parcels, and we're going to credit cash $10,000. Now, since we're using the cash to purchase land, land is a non-current asset, and all changes in non-current assets are an investing activity, aren't they? Number 4, paid $5,000 to rent lawn equipment for the remainder of the year. So here we're not buying lawn equipment. We have rent expense on that lawn equipment for $5,000. Credit cash, $5,000. Since that cash outflow was going for rent or an expense, that's a normal operating activity, and you'll remember operating activities are changes in current assets, current liabilities, or things that would change on the income statement. In other words, revenues and expenses. Number 5, provided lawn services to customers. So we sold customers some lawn services. So we received $10,000 in cash. So I'm going to debit cash, $10,000. And the customers also still owe me $4,000 in receivables. And we remember that's called accounts receivable. And we're going to credit lawn service revenue because that's why we're in business. We're in business to sell lawn services to customers for $14,000. Now when we look at the cash flow statement, notice our cash went up $10,000 and that was from daily operations, so that's an operating activity, isn't it? All right, number 6. Paid cash for miscellaneous expenses, $4,000. Debit miscellaneous expense, $4,000. Credit cash, $4,000. Since cash flowed out to pay these expenses, an expense change is an operating activity. In number 7, we sold one of the parcels of land with a cost of $3,000 for $2,800 cash. So I'm receiving cash of $2,800, but my land is being reduced by $3,000, the cost of the land, and that doesn't balance. We need another debit for $200, and since we sold the land for less than we purchased it for, it's a loss. Now, because land is a non-current asset, the cash inflow is an investing activity. And finally, paid $2,200 in dividends to shareholders. So I'm going to debit dividends which is the shareholders' equity account, and I'm going to credit cash, $2,200. Now, since our cash is flowing out for a shareholders' equity account, it would be a financing activity. You're right. So those are the transactions in journal entry form, and notice that every journal entry, the debits come first, the credits are second and indented, both in the account and in the amount. Stay tuned. We're now going to be putting these in their T accounts and then preparing financial statements.